welcome back to another episode of Risk Runner. I'm your host, Steve Falasca, of course, joined by Tony Mulvey. We've got a lot going on here today that we need to discuss. For starters, spot rates are continuing to decline. Flatbed tender rejection rates are continuing to show some softening. However, there are a few individual markets that are actually showing some bullish movement, which we'll take a look at. But speaking of bullish moves, Tony, the stock market's rebounding a little bit, finding a little bit of a floor, maybe a little bit of love.
Yeah, I mean, not going to complain, right? I mean, if you're in the market, that always be buying, right?
Always be buying, ABB.
Good time to buy was a few weeks ago, it seems like.
Especially still a good time to buy. We're
always.
Still off our highs quite a bit, so
now,
always a good time to buy.
The question is, did you get in on the latest meme stock?
Tony, you know me.
You're a Wall Street bets guy. Come on now.
So it's funny. I know where you're going with this. I was a part of Wall Street Bets back in like 2018, back in the early days, and because I'm a big deal. But anyways, the thing is, and then I left it, and you told me to go check out Wall Street Bets today so I could see what's going on. And I had to join Wall Street Bets, and I get this long list of like all these rules that they have to follow now, and I was like, what? This is like breaking all of what Wall Street Bets stood for. They have all these rules now. But anyways. Yes, there is the latest meme stock. No, I did not get in on it. I've become, I guess, a boomer in my investing, and all I do is buy ETFs now. The long, slow grind. So I'm not 10,000xing my money in a couple weeks.
I'm not either, so I don't feel bad. I didn't even know it was a thing until headlines of CNBC this morning shows a stock that goes up 21,000% in 2 weeks.
Let's say that again. 21,000% in 2 weeks.
Yeah, no.
2 weeks.
Not involved.
First off, 21,000% period. But in 2 weeks?
Yeah, something seems a little fishy.
Yeah. I mean, you should get a 21,000% return in like over 50 years.
If you're lucky.
Yeah.
Or if you're really, really good.
But like in 2 weeks, you couldn't rob a casino. You couldn't cheat at a casino good enough to even do that.
Yeah.
You couldn't walk into a casino with loaded dice at the craps table with the crab dealer knowing that they're loaded and allowing it to happen and walk out with that return in a night of gambling.
No, I don't think you could. No way.
Like, there's no...
It's unfathomable.
To give you an idea, a $5,000 investment would net you $1.1 million in 2 weeks. How to turn $5,000 into $1.1 million in 2 weeks. What's the stock that we've been talking about right now?
I don't even know what it does, but the ticker is AMTD. Or
AMTD.
HKD here.
HKD.
Yeah.
So HKD, it trades originally on the Hong Kong exchange, correct?
Yeah, company out of Singapore.
Company out of Singapore, and they as of I guess mid-July, you were able to trade it on the New York Stock Exchange, correct?
Yep, that's correct. And then
and it took off.
Yeah.
Went from zero to $150 billion market cap.
Crazy. Shows that financial markets
Maybe whoever won the lottery, the $1 billion Powerball, just bought all the shares.
There's no telling. Honestly, no telling.
Maybe so.
So
I hope that's the case.
I mean, I think I'd rather take the lottery winnings.
I think I'd definitely rather take the lottery
play with stocks like that, for sure.
Be great. You could buy a lot of pizza.
You could.
You don't need to order water anymore at a restaurant. All of a sudden, you can get a drink.
Those Cokes go down a lot smoother when you're having about $500 million.
I was saying you got $500 million in your pocket. All of a sudden, it's you don't need that 2-for-1 special anymore. You're off the dollar menu. But anyways, that's not what we're here to talk about today. There is some actual freight bullish movement that we're going to talk about today, but also some downward pressure in other sectors. So the market's not reacting the same, right? I think as a general rule, the market has been flat the last few weeks.
Yeah.
General rule, market's been flat. But there are isolated situations where the market is continuing to fall and isolated situations where the market is seeing some upward pressure. So we're going to take a look at that today.
Yeah.
I think first and foremost, we got to just throw up volume, right? All roads are from demand. We know that. By the way, you like the new colors today? Look at that orange.
I know.
Isn't that nice? That's me.
Is that the old Milligan colors?
It is the old Milligan colors. For those of you who didn't know, you can customize your sonar charts to make them look how you want to make them to look. I'm basically, like a graphic designer, as you can tell right here, with these amazing colors. So it's we all have our talents. But this right here, so truckload volume, we've been seeing this. What I do think is interesting, though, is we have seen a slight decline last couple of days.
Yeah.
We're starting to kind of see that next tick down in August, which is interesting because last August we actually started to go up a little bit.
Yeah, it is interesting. But when you think about the freight market as a whole, if you look back at July, it was pretty flat. You saw an ever so slight tick up right there at the end. And I'm talking like less than 1% increase in that final week. So, I mean, that just, when you're not seeing that rush of things moving off docks at the end of a month, like it just means that beginning of the next month typically ends up pretty soft. And that's kind of what we're seeing here. I mean, what does this mean for the rest of August? Do we see some recovery in the back half? Maybe. But I mean, even then, it's like you still look at these levels and compare them to where they were in 2019, and they're obviously still elevated, right? I mean, and that's going to take some time. I mean, we've talked about the warehouse situation, inventory levels. You look off the coast, ships are still built up, but a lot of the times there's nowhere for that stuff to go, right? And that's a lot of why you're seeing this decline is there's nowhere for things to go anymore, right? So you're seeing that slowdown.
Too much inventory.
Yep, and that's going to be, what's going to be interesting is what happens through the fourth quarter.
We actually saw probably not much, if you've been following a lot of the Sonar stuff, probably not much of a surprise. So Maersk reported earnings the other day, and they beat earnings estimates. They had very good earnings. Probably not much of a surprise there, right? Still, those rates were coming down in Q2, so they were still able to benefit from the elevated levels before they dropped to where they are now. But they gave guidance, and they basically said that we were expecting a slight decline in volume in the end of the year. And one of their biggest sites for that was there's too much inventory out there. There's not enough places to move the freight. They cited a few other issues as well, like some geopolitical constraints, right? You still have the war in Russia going on in Ukraine. But as a whole, they did cite in lower volume guidance just a little bit.
That doesn't, I mean, it doesn't really surprise me when you think about if you look off the coast here, right?
Yeah.
For what's coming, what's off the coast here has already been booked. Mm-hmm. They've already basically generated that revenue. Granted, they just need to get the containers off. But then you think about they've got to get all the way back across the ocean, get loaded again, and then back, right, within the next. So you're looking at what? Almost a month to get unloaded at this point. You've got, 15 to 20 days plus to get back over across the ocean, if not more. And then you've got another month basically back.
Yeah, so basically 90 days.
You've got 90 days, and we're August, right? And you think about when the ocean season is strong, it's in September.
Right.
And early October. It's not in November and December. So, I mean, you look at 90 days from now, you're talking about early November, not... Right. So you're past that peak. So it's like what's already, some of this congestion is going to drive some of those lower volumes. And I mean, like they said, inventory levels, people don't need as much stuff. You're starting to see it show up in some of these other indicators, right? Where new orders in contraction are right there at like the 50 level in the new, I guess it's the PMI. So, I mean, it's just some of those, what you're seeing is just this broad trend of, we over-ordered, and now we're suffering the back half of that over-ordering.
Yeah, and it's interesting too because while demand is significantly lower as a whole, that because of those shifts in the supply chain, right? You have bottlenecks, but like Greg Miller, for example, one of the folks on the editorial team, he's been writing a lot about how ships waiting off coast in the United States are at an all-time high, higher than they were when we had that real big demand surge. The difference is before we had so many ships waiting off the coast because there wasn't enough demand to bring, we couldn't get them through the ports fast enough. Now they're waiting off ports because they're waiting for a place to just put the stuff.
Yeah, exactly.
Right? So it's same problem, but a different cause.
Exactly, and that's why you can't take, and I think this is a lot of the issue that people don't highlight is they're just talking about the congestion, right? It's the same problem, and it's two completely different problems, right? We needed to get that stuff on the shelves. The docks couldn't clear it fast enough to get it, right? that's what drove up those prices. It's what drove up rates in the trucking market. It's what drove, because it was kind of a name your price. I know you need it. Guess what? I'm going to squeeze you for every penny I can get. Now, on the flip side, it's, hey, we have all this stuff. I mean, you look at Walmart pre-announcing, we've got too much inventory. We're going to have to mark down clothing and some of those hard goods that they brought in thinking that consumer demand was going to be there. And it's since shifted to more groceries and fuel, which, I mean, Walmart still benefits being the largest grocer and having fuel. But when you think about it to some of these other retailers, right, that don't necessarily have that benefit, what incentive do they have to bring in more inventory now? None.
Very little.
Yeah, exactly. It hurts their balance sheets in the long run. So that's going to be, like you said, it's the same problem but different root causes.
Yeah, different root causes. Very, very true. And it's affecting different segments differently. I think that the next chart that we'll go into here is the tender rejections of some of those different segments, and we'll really see how it plays out. So we'll throw that on the screen here. And again, folks, we've seen this chart before. So some of you may be familiar with this. Again, look at those beautiful colors. I mean, we're like can I be the art director at FreightWaves? Is that a role? Is that a role? But in all reality, the blue line, or excuse me, the orange line there. I'm so used to saying the blue line. It's not blue anymore. It's orange. Yeah. Look at that, or orange if you prefer. But the orange line is going down, and we're sitting right around 6% now on van. Right, that orange line represents the van tender rejection rates. Again, very flat. It's maybe ticked just barely at its 52-week low there, but for the most part, it's been flat last few weeks. Same thing with that purple line there. That is going to be the reefer tender rejection rates. Again, they had a much sharper decline or a more rapid decline than van there in orange, but again, sitting there flat. But the real one that we're going to talk about is that flatbed, right? I mean, look at that. That peaked out in March there. That's that blue line. And that has, I mean, it's continuing to soften. A slight uptick last couple of days, but again, for the most part, it's continuing to soften. Still a little bit tighter than the other two, but seems to be closing that gap.
Yeah, and I mean, it's not really expected when you start seeing data that's coming in, right? Construction spending, housing starts, things like that, they're all declining. We saw that really start, end of March or early March, April? Yeah. So we saw that softening in the flatbed market, so we knew it was coming. Yeah. It's just a matter of when it actually catches up, right? Yeah. And that's one of the things with this government data is it's lagging, right? It takes some time to get everything cleared and to report it, whereas this is real time. Yeah, it's a lot softer, but I mean, we're still talking 17%. So it's not like, I mean, carriers in the flatbed space still have some pricing power, whereas...
Yeah, I would... At 17% tender rejection flatbed, I would still give carriers the upper hand. Yeah. Just not as much of an upper hand as they have, but I would still give them the upper hand.
Yeah, I mean, previously we thought that 7 to 10% was kind of where carriers had that upper hand in pricing. And obviously the pandemic kind of changed that a little. And now, I mean, we look at 6%, right? I mean, it's still on the van and reefer side. I mean, I don't remember any time that we've seen reefer rejections below 7%. I don't even know if during the depths of the pandemic, we saw them this low because, I mean, you still, the necessities that went via reefer during that time, I don't think they ever got this low. So, I mean, that's the one of this chart that concerns me probably the most and like where those carriers have lost that pricing power pretty significantly.
Yeah, it'll be interesting to see when that one really kicks into gear and how that impacts the reefer business. Let's go ahead and look up the results of all this. So that's the supply and demand, right? We've seen volume now, largely flat, slight decline further. Tender rejections, again, still continuing to decline. Now it's the pricing side of that. Again, beautiful orange chart there by yours truly. So the orange chart there, that is the van contract rate per mile in the United States there. Again, pretty much been flat since March. Hasn't changed. I think it reached its ceiling. We know that. The question is how quickly does it come down? And I think we're really going to start to see it come down in the fall as these shippers start to renegotiate. And this is line haul, by the way. We've pulled off fuel. The blue line there is line haul spot rates. Now that it seems like spot rates have found their bottom, at least in the short term, and I think a lot of shippers were waiting for that. They were waiting to figure out, are spot rates going to continue to decline further? Are they going to stop here? And now it seems like we have found a short-term bottom, so we should start to see those shippers start to renegotiate.
Yeah, I mean, we talked a few weeks ago with Emerge, right? And like rates are where they need to be to see that. It just takes some time. And I think that's what's going to be the interesting part is how much time does it actually take for this to happen? I think like you said, I think we're getting close. I mean, you think, all right, if you look back half of June is about where we are now, right? So we've been here for 45 days. I think that's where you're going to start to see, all right, we can either move stuff to the spot market and chasing these more favorable rates from a shipper's perspective, and at the same time, start running through this RFP, implementing it, things like this, these shorter bid cycles. Now, what I do think is interesting here, not from a carrier shipper's perspective, but from a broker's perspective, this is where you're making your money.
Oh, yeah.
Right? I mean, we talk about it all the time. Brokers like the volatility, but they like when they can push their costs down to carriers, and they can sell their shippers or basically get volume from their shippers at these higher prices, and that's exactly what this chart shows.
Oh, yeah.
So, I mean, this is a chart I wrote about in the Daily Watch. If you start looking through earnings reports from some of these brokerages, except Landstar, and we won't talk into that because that's a whole different business model as a whole than just like a pure play brokerage. But you look at like a CH Robinson, right? Largest brokerage in the country. And you see how they reacted, and they saw margin expansion, right? And a pretty hefty one. JB Hunt's brokerage segment saw pretty hefty margin expansion. And guess what? It's for this reason alone. What their customers paid them was elevated, and they were able to push the rates to carriers down. And that's exactly what we see in this chart.
If you're a broker right now and you're not making hand over fist, you're doing something wrong.
Yeah, I mean,
you're doing something wrong. Now that party may start to slow down soon, but right now, right, it's a good time. Now you might have some volume that you lose.
Yeah,
but the margin should be exponentially growing.
Yeah, so I mean that comes into the actual like business dynamics and if you want to continue to grow volume, you may take a hit on margin, but if you're being judged solely on your margin, right now is the time that you should be exceeding expectations.
Yeah, no, it's very exciting. So we've talked about potential downward pressure in a lot of ways, but let's talk about some of those bullish moves. We don't have any 21,000% gainers, but we do have some areas of the country that are experiencing some growth. And Detroit's one of those. Before we look at Detroit, though, right? Tony, kind of give us a summary. We all know who's up in Detroit and some of the surrounding areas, right?
Yeah.
Those are the big car manufacturers. A lot of auto parts are up there too, right? It's not just the car makers, but all of the resources that go into that. What is when logistics and carriers think about hauling freight for some for that region? Is it different from, say, other regions? What kind of sparks the type of freight that comes out of there, basically?
A little. I mean, you have to think about that market too, because if you think cross border, right?
Yeah.
Really close. What is it? Is it the Eisenhower Bridge or one of the bridges right there connects into Canada? There's a lot of those auto manufacturing facilities in Canada as well.
A lot of short haul too, because they're moving stuff around plants.
Exactly. So I mean, you're dealing with down into Indiana and Kentucky's and things like that. So, and it's a lot more of that just in time, right?
Yeah.
You've got to, if you don't get this load there, the factory shuts down, the plant shuts down. Like it's more of that than opposed to like, hey, if the apparel's a day late, it's not the end of the world, right?
Yeah.
So that's where some of those dynamics in Detroit are very interesting. But I mean, like you talked about, it's one of those markets that's been changing. There's been that positive momentum, and we're seeing it in the volumes. Granted, rejection rates have come down in the past week, but they're still relatively strong, right? And guess what? I mean, that's what leads rates. So it kind of gives you an idea of what rates out of Detroit are doing.
Yeah, no, spot on. So let's go ahead and pull up Detroit here just so we can see a little bit, right? So this is the outbound tender volume index. This is over the last 5 years, so pretty much since the beginning of 2018, or around this time in 2018. And look at that. I mean, there's actually some pretty consistent growth up there for the most part. which may not be a huge surprise. Now, this is overall tender volume, so again, a lot of this is going to be contract. So it's probably not surprising that you see more volume in 2019 because a lot of that freight moved off the spot market there and went to contract tenders. But I mean, look at that. We saw a giant. We're seeing still. I mean, a lot of spikes there in the volume. Some of those big dips you see there, by the way, those are just holiday dips, so very very normal. We see those every year, but I mean, overall, we're still pretty much at that 52-week high on the volume side.
Yeah, I mean, and that's a positive. I mean, you look at this and you're like, it's Detroit, right? I mean, it kind of, when you think about Detroit, it's auto parts and things like that. So, I mean, it does factor into here. And we talked about it for the past few years, the issues that auto manufacturers have had getting parts, getting supplies. And guess what? Some of that is starting to alleviate itself, right? It's kind of like this whole supply chain's kind of unwinding itself after being tightened so much thanks to the pandemic. This is one area that is going to be one market that will benefit from some of that unwinding, and it's proving out right here in the chart.
Yeah, absolutely. It'll be interesting to see where this chart goes and see how we see some of those sectors in different places. The Los Angeles market is probably a little bit. I mean, Los Angeles has everything, but it is very heavy on the retail side as a lot of those finished retail goods come in from the ports. And we saw that market soften first at the very beginning of the year. So it's fun to see how some of this stuff does play out in different markets that are maybe a little bit more biased towards one industry versus another.
Yeah, and I mean, just being kind of biased to that industry does make it, by nature, a little more volatile. Yeah. Right. So you see these ebbs and flows spikes there, right? And that is one thing to remember. Detroit. It's more of the consistent volume growth. I mean, if you look at this chart, look at how high it's been for the last few months, right? Not just week to week. It may change pretty dramatically, but over the course of that longer trend that shippers are looking for and carriers are looking for, it's been elevated, right? The brokers want that volatility, but a shipper wants pretty consistent. They want those longer term trends, and that's where, looking at it over 5 years, you can kind of see that growth that we've been seeing. And it wasn't just the pandemic, because it looks very different than the overall volume chart if you put it up there.
Now, Tony, we have to talk about something very important here. So if you could go back in time 2 weeks, right, what are you doing to get more money to dump into that meme stock that was up 21,000%?
Nothing. I mean, I'm not touching that thing I wouldn't touch that thing with a 10-foot pole.
But you get to go back 2 weeks. You know what's going to happen.
At that level, there's no liquidity. That's the issue.
Like, you are the liquidity.
Who's buying? Yeah, who's buying it after it's gone up that much?
That's a good question.
Exactly.
It doesn't matter, but you get to sell.
But maybe. If you're lucky. So no.
That one is interesting. It'll be interesting to see how that one plays out.
Yeah, I mean it
was down 50% today?
Something like that. It's not like GameStop where you know what it is, right? You can go see the store. Like, I'm not gonna.
How much revenue? You looked up the company. How much revenue did they have?
I think $25 million.
$25 million in revenue, and they're worth $150 billion.
Yeah.
$150 billion.
Yeah. The market cap to revenue was like 12.4 thousand.
So let's talk about that.
In comparison to
12.4 thousand ratio, meaning if I have $1 in revenue, my company's value is 12,000 plus
400. Yeah. In comparison,
it's not a bad ratio.
Berkshire Hathaway was like 1.8, and a lot of the banks are right around 2. So I mean, that just kind of gives you an idea of how overblown it kind of is.
You'll love to see it.
You do if you were one of the people in it at $7, not the people in it at $1,600.
Yeah. Well, like I said, I'm just buying the ETFs. I'm the low, slow grind here, right?
And me
just hoping to double my money in 300 years. So, it's fine. We'll get there. But anyways, I'm excited. We're not going to be here next week, but also, I gotta let you guys know now. In just a few months, in November, is going to be F3, the Future of Freight Festival. It's going to be the best freight show. I mean, it's more than a freight conference at this point.
Yeah.
Like it's going to be a 3-day party. More importantly, Tony and I are doing with Sonar every day of the event. So it's going to be a blast. You get to hang out with us. I think we need to have somebody win like 15 minutes on the show with us.
Yeah.
Who watches?
That'd be a good one.
Somebody. It doesn't even matter if they're a customer. It doesn't matter. We should just have somebody on here and we'll talk. Maybe we'll talk about meme stocks. Who knows? But anyways, mark your calendars in November. All right. F3, it's going to be here in Chattanooga, Tennessee. It's going to be a great time. I'm excited.
Oh, I am too. I mean, heck, Future Supply Chain was my first FreightWaves event. It was awesome. Being at home, putting on the show is going to be, I have a feeling it's going to be, I don't want to put a number on it, but it's definitely going to be better than Future Supply Chain, which was
exponentially.
Awesome. Yeah.
Exponentially. Yeah. And there's already more people signed up to go to F3 than there was at Future Supply Chain. So it's going to be exciting. Anyways, folks, we will see you every Wednesday, 3:30 p.m. It's Luke. It's Tony. Have a good rest of your Wednesday.